Thank you for joining us for our quarterly outlook. As the third quarter drew to an end, equities rallied nicely such that in domestic markets, most of the popular averages were close to their all-time highs. Given our somewhat modest concerns about the pace of global growth and earnings, and not to mention relatively full valuations for equities, we took that opportunity to reduce equities in our domestic allocation to neutral. It's the first time in over 7 years that we have been as low as neutral as far as our recommended target allocation for U.S. stocks. In fact, with that move, it actually took the recommended allocation for all of our major asset classes to neutral. Stocks, domestically, international equities, real estate, and bonds all right now are carrying a neutral allocation. In other words, the midpoint of clients' asset allocation range. The story hasn't really changed in the entirety of this year. The big issue is global growth is hard to find. Wherever you look, growth is slow. This chart plots the relative sizes of the major economies in the world based on the size of the circle. And then on the y-axis, we show the rate of change. In other words, are they expanding or contracting? Which direction is the change, either growing or contracting? And then along the x-axis here, with the 0 point being here, how is the absolute size of the economy now? Is it growing at 5%, 2%, 6%, contracting? And as you can see, most of the major economies are right around the zero line. In other words, they're not changing very rapidly, either expanding or contracting. And the absolute growth rate is between 0 and 2% for the majority of the world. The US is growing around 2%, Europe about 1%, Japan around 0%. China around 5 to 6%. So the fact is, growth is hard to find in the world. Global growth had been averaging for the previous generation about 3.5%, and since 2008, it has been about 2%. So people are frustrated. That has some impact on what's happening politically here as well as other developed economies. With growth being hard to find and slowing, central bankers, as we all know, have been very aggressive in cutting rates and being very aggressive with their monetary policy to try to drive growth. And this chart is just another way expressing that interest rates are low and why we think they're going to stay lower longer. What we've plotted here is going back to the beginning of 2014 through the end of the quarter. What percent of the world's sovereign debt has a yield in blue less than 1%, and the green represents sovereign debt from other nations whose debt is yielding below zero, in other words, negative yields. And the point here is that a tremendous amount, 85% of the debt issued by sovereign nations now have a yield less than 1%. And because of that, capital flows where it can get more attractive yields, namely the United States, keeping yields lower than they otherwise would be. And whether the Fed raises rates here in December or even November, which is maybe a coin toss whether they'll do that at this point, that would only raise rates on the short end of the curve, probably not impact the longer end very much, if at all. So our thesis that has changed in recent months, that we think rates are going to be lower longer because of what's happening beyond our borders, continues to be very much an important macro force. Now, the U.S. Is one of the very best economies, certainly the best developed economy, growing at about 2%. And a couple of data points here. Household net worth is at an all-time high of almost $90 trillion. Real wages are growing at a more rapid pace than we've seen in almost a decade. Of course, unemployment below 5%. Savings rate has really taken off, approaching 6%, which is good news and bad news. On one level, you want the consumer to spend because they're 70% of the economy. On the other hand, you want their balance sheet to be in good shape. So the consumer's saving, and we talked about that at the outlook at the beginning of the year. But the bottom line is the U.S. economy is in good shape. It's not growing as rapidly as people would like, but it's in good shape, and no recession is near. As far as stocks go, there's three things that drive stocks: earnings, how much investors are willing to pay for a dollar of earnings, and capital flows. And earnings have been a problem for the equity market. It's been an impediment in recent years because earnings have been flat. There's a lot of data on this page, but what we're showing in the shaded area is what estimates were at the beginning of each given year for the S&P 500 and what earnings actually were by the end of the year. So in 2014, the estimates at the beginning of the year were for earnings in aggregate of $122. By the end of the year, however, in 2014, the S&P had earned $117. Last year, in 2015, expectations at the beginning of the year were for almost $130 and came in virtually flat at $116. And earnings went nowhere, as you can see, and the stock market went essentially nowhere also last year. As we began 2016, the hope was for $125 based on consensus expectations. And now, halfway through the earnings season this year, estimates are trending for about $117. In other words, flat. The reason equities are up is not because earnings are up, but because PE multiples, in other words, how much people are willing to pay for a dollar of earnings, has increased because interest rates have declined. Our base case has been that the reason earnings fell so much relative to expectation last year in particular was the plunging oil prices hurting energy earnings and a strong dollar hurting exports. And our thesis going into this year was that we'd seen the low in oil prices and that the dollar, the bulk of the strength, was behind it. And so far, so good on that. That's really started to happen in spades here in the last couple of weeks with oil now approaching $50. So we think for a change, the error of the estimate is going to actually turn positive and revision activity is going to start going the other way positively, which can provide, we think, some catalyst for stocks to go higher. As far as how much people will pay for a dollar of earnings, this is a chart that we've shown before. I think it's really interesting where going left to right, we've taken a look historically at different price earnings multiples and what stocks have done the following year from that multiple. And it's pretty simple and pretty clear. The lower the PE multiple, the higher the actual return in the market. So when PE multiples have been 10 times or less, the return going forward on average 1 year out has averaged almost 13%. When multiples were between 10 and 14 times, the average return had been 12%. Well, we're here now. We're trading at 18 times trailing earnings. So right between these two bars, so between an expected average return of 8% and 3%. So it's not that we think that we're headed to a bear market per se, but the fact is that the risk reward for stocks is not as attractive as it had been when multiples were lower. One thing to point out, the way the math works, however, if rates stay low and we get some multiple expansion, say just one point from 18 times earnings to 19 times earnings, that would translate to a 5% move in the stock market. So there is still some room for multiple expansion, but the risk reward is less compelling, thus a lower allocation to equities. As far as the flow of funds, this has definitely been the no respect bull market, and thus the Rodney Dangerfield reference here. What we're plotting is capital flows into equity funds or in and out of equity funds since the market bottom in February of 2009. And as you can see, the vast majority of the time, investors have been liquidating equities, with some exception here in 2013 late and into 2014. Investors have liquidated over $1 trillion in equities, and that money has gone into bond funds. $1.5 trillion over that same period has gone into bond funds. All the while, stocks, as presented here by the S&P over that period, S&P is up 220%, bonds are up 42%. Investors have been exiting the market. Jason Trennert, a very well-respected strategist on Wall Street, coined a phrase a couple of years ago. It's actually an acronym, TINA, there is no alternative, with the belief that when interest rates are low enough, as the central bankers have tried to do, investors will have no alternative but to put more money into risky assets. That hasn't been the case, as you can see here, but we think this year that could be the case with interest rates so low and equity markets providing some nice returns for people. That investors might actually start putting more money into riskier assets, driving equity prices higher on the margin. So again, this is something that could serve as a catalyst, and another reason why we're not underweight equities at this point. In summary, as we said at the outset, from an asset allocation standpoint, we recommend a neutral allocation for all the major asset classes. In other words, the midpoint between minimum and maximum as specified by guidelines. Regarding U.S. equities, we're focusing on companies that are generators of free cash flow in an environment that's a low nominal return environment. Companies that have cash to buy back shares and increase dividends we think will be attractive. With respect to international equities, we favor emerging markets over developed because of their more attractive growth rates. As has been the case for a couple of years, we remain underweight commodities, the exception being energy, and that's finally starting to pay off nicely. And finally, we're a month away from the election, and our point of view hasn't changed here since the last quarter. We're very much consensus view that the Democrats will hold the White House, the Republicans the House, the Congress, the Senate is a coin toss at this point. But the fact is that we've had sector allocations with that in mind for some time, and we don't expect the election to be a capital market event at all. So with that, we hope everybody has a great fall, and we look forward to visiting with you in the new year.